Hey, what's up students? In today's video, we're going to be talking about how to make journal entries in Excel. Now, first off, what are journal entries? So journal entries basically help companies categorize all their transactions throughout the year. They have to mark them down, if you will, or record them, right? Because if you don't, you're going to forget what happened during the year. Now with journal entries, there's going to be something called debits and credits. Now what are debits and credits? I'm sure you've heard about it. We're not going to go too in depth in this video about that because this video is really about how to record these journal entries in Excel. Now, but debits and credits really have to do with the types of accounts in accounting. And basically, if you want to increase an account or decrease an account, debits and credits dictate that. But it depends on the type of account. So for example, if you have an asset and you want to increase it, you debit it. But if that same asset and you want to decrease it, you credit it. So assets debit to increase and credit to decrease. That's how assets work. If you have a liability, right, when you want to increase a liability, you credit it. But when you want to decrease a liability, you debit it. That's how liabilities work. Same with equity. Stockholders' equity, if you want to increase it, you credit it. But if you want to decrease it, you debit it. And that's how debits and credits work, depending on the account itself. Now, where do these journal entries go? Well, they go into something called a general journal. That's where you keep track of all the journal entries throughout the year. Now, how do you make journal entries in Excel? Let's get into it. All right, so how do you make journal entries in Excel? We're going to go through a full example here where I'm going to go through the trial balance, go through journal entries throughout the year, adjusting entries, and an adjusted trial balance. So you can kind of see part of the cycle here of accounting. We're going to use a fake company called Jimbo Corp. We're going to go through here and talk about these different transactions and learn how to make journal entries in Excel. So going down here, first we have our trial balance. This just goes through all the different types of accounts we have already, and then making sure that your debits, which is on this side here, and I'll write this in, equal your credits. So cash is a natural debit balance, and then you have a lot of other debit accounts here, and then on the right side you have some credit accounts. As you see at the end, they both equal each other. That's called a trial balance, making sure that works. We're going to go through some transactions though during the year. We're going to go and record and make these journal entries in Excel as you're seeing, and then we're going to make an adjusted trial balance with all the updated information. So first off here, let's talk about this. So on January 18th, Jimbo, he bought some supplies for $2,200 to be used in the business. So he bought supplies, so he got supplies. So we know that we're going to debit here, and we know that we talked about this earlier, assets will increase with a debit. If he got supplies, that means its assets are going up. So we're going to debit here supplies for $2,200. And then we paid for it though, right? We paid for it in cash. So what's going to happen is since assets are going down, right? Cash is going down, we're going to credit cash here for $2,200. And I indent this number here because debit always goes first to the far left and then cash will go to the right. That's how journal entries work here, especially in Excel. So not too bad. Let's go and try the next one. So during the month of March, Jimbo, he sold 20 units on account at $25 each. So he sold 20 units on account for $25 each. Well, he sold, that means he got something for it, right? He sold something, so he got something for it. And what he got was he's going to get cash. So we're going to debit here cash for a certain amount. Now, what are we going to debit it for? Well, we have to do 20 units at $25 each. So the best way to do this is we're going to do this in Excel. We're going to do equals, open parentheses, we'll do 20 times 25. There you go, $500 he got. Now, what do we credit here? Because with journal entries, I'm not sure if I explained it, but debits must always equal credits. They must always balance. So we're going to credit here something called sales revenue. because he sold something. If you sell something, you're going to record a revenue. Sales revenue is considered part of equity. If you remember earlier on in the video, we talked about equity. Well, when it increases, you're going to credit it. So it's also 500 there. Now here's the thing though. Since I'm going to go ahead and create a few different rows here. Since we sold some inventory, we have to record what that inventory cost us. And so here we know each unit costs $12, right? Because you sell it for more than what you got it for. If you don't, you're not going to make any profit. So make sure you record both the sale and what it cost you. So what we do is we do a debit here for the cost, and we call this cost of goods sold. It's the cost of what you sell. And to get that number, it's going to be $12 for each unit, and you sold 20 of them. So you do equals $12 times 20. Cost you $240. That's on the debit side. On the credit side, we have to show it leaving our inventory. We sold that inventory, so it leaves our inventory. So we do credit inventory for also the same thing, $240. So they call this the matching principle, where revenues must match your expenses. And this is an expense right here, and this is a revenue. Hopefully that helps. That's what you have to do on a sale. So on April 20th, Jimbo issued 400 shares of stock at $40 each, par value $8. So he issued shares of stock. That means he gave out stock and he got cash in exchange for it. So we know we got cash, right? And cash is an asset, so we debit it. So we debit cash for how much? Well, he sold 400 shares, so we'll do equals 400 shares, and we know it's at $40 each. And there you go, $16,000. Now, something in Excel, if you want to make this a number, or I guess a currency, you can go right up here and do that, and it changes it to a currency. And when there's a debit, there's always a credit. So we're going to credit two things here. One, we're going to credit our common stock. Now, common stock, we're going to credit it for what we call the par value. The par value is right there, $8. So you do, you're going to credit $8 times those 400 shares, 3,200. We're also going to credit, because remember, debits have to equal credits, right? So we're going to credit additional paid in capital. And that's going to be the difference between your cash and your common stock. So you do equals this number minus this number. And there you go, 12,800. Additional paid in capital. Common stock and additional paid in capital, those are both part of stockholders' equity. And that's why we credit them to increase them, because equity is increased with a credit. Now next, during August, Jimbo purchased a building for $45,200 in cash. The building has a 20-year life with $2,300 salvage value. We'll talk about the second sentence in a little bit when we do adjusting entries. But right now, we're just going to talk about him purchasing a building. So we know that he got a building, so we're going to debit, because building is an asset, we debit it to increase it. And you do it for what it's worth, $45,200. He paid cash. Cash is going down. Cash is an asset. We credit cash. And there you go. Now, next, Jimbo bought 12 months of rent in advance for one of its warehouses. They bought rent for $54,800. So you're buying it up front. If you've seen my assets video, we talked about prepaid, and that's what this is. So we're going to debit here what we call prepaid rent. You're buying rent in advance. You're prepaying for it for $54,800. We're going to credit here. We paid for it in cash, so we credit cash for $54,800 as well. Like that. Very simple. Now, November 12th, Jimbo paid off $32,400 of their accounts payable. They had accounts payable on the books, so now they're paying off some of that. So here's the tricky part. Accounts payable is naturally a credit. So when you increase accounts payable, which is a liability, you credit it. But now you're paying it off. So to pay it off, you do the opposite. You're going to debit it and not credit it. So we're going to debit here accounts payable for $32,400. and we paid it off. So if we pay it off, that means cash is going down. So we have to credit cash, 32,400. So that's how that looks there when you pay off an accounts payable or pay off a liability. You're going to debit that liability to remove part of it from the books and then credit cash for what you paid. December 22nd, Jimbo sold their land. So you're selling land for $28,750. Now here's the key thing here. We know we're selling land and we're going to get cash for that. So we know right away it's going to be a debit to our cash for that amount. Here's the thing about land though. What did we buy it for and then what did we sell it for? If there's a difference there, it's going to be a gain or a loss. So let's take a look here. Land was $38,700 when we got it, but then we only sold it for $28,750. Interesting. So what we're going to do here is going to be a debit to loss on sale. I know it's a loss, and I'll tell you why. Because what we sold it for is less than what we got it for. So that's a loss on the sale. So how do we calculate that? We do equals, go up here, take this number minus this number. And that's our loss. Lastly, we would credit, we're getting rid of it, which is land. We credit land for what it was originally worth, which is equal to the sum of these numbers here. Up plus here. This number. Sorry about that. This number plus this number. There we go. And that's what we're getting. Remember, debits always have to equal credits, and these have to match up. All right, now we're getting to adjusting entries. Adjusting entries are basically adjustments that you make at the end of the period based on time or based on something you used up. Now with depreciation, that's based on time. So we're going to record depreciation here. To record this, we'll debit something called a depreciation expense. In lower level accounting, this is an important rule here. Expenses always debit. And then the same token, revenues always credit. Very important rules to write down. So I know it's a depreciation expense, and if it's an expense, you always debit it. Now that's only really for lower level accounting. When you get into upper level, rules kind of change a bit. But how do we calculate this depreciation expense? Well, we have to go back up here to when we got this building here. It has a 20-year life with 2,300 salvage value. So what we're going to do here is we're going to record depreciation based on what they call straight line. So go down here, equals, here's how it's going to work. We're going to do equals the cost of this building minus the salvage value. All right, so cost minus salvage divided by life, which is going to be 20 years. So that is, oops, it didn't like that. Oh, I see why. Let's try this again. Hold up, hold up. It's not liking that. Let's try this instead. Hold on. I'm going to do this. So give me 1 sec. So I'll put 20 over here and 2,300 here. Equals this number minus this number divided by this number. There we go. So 2,145 is how much we depreciate every year. That's the full annual amount of depreciation. Now, here's the thing. It says during August we got this. We'll just assume at the beginning of August. So it's not been a full year, right? Because we're at the end of the year here, right? December 31st. How many months is it from August to the end of December? That's what you're asking yourself here. Let's count them. August, September, October, November, December. So 5 months. So what we have to do here is we have to take this number. We're going to go ahead and move this over here for now. We're going to take this number equals this number, and we're multiplying it times the amount of months that have passed. 5 months have passed. 5 over 12. Right? And that's the portion that's depreciated this year because, again, it wasn't a full year. Hopefully you see that, and I'll make this green so it's all looking good there. Now, What we're going to do next is we're going to credit what we call accumulated depreciation. And that's just going to be the same number here. Accumulated depreciation just represents how much has it depreciated so far, and we're just adding that to the balance. That's all we're doing. Now we record an adjustment for prepaid rent. If you remember, we got rent on here, but this was on September 15th. So we got to figure out how much rent have we used up. Well, we look at the time, right? So we know we got 12 months of rent here. So how much time has passed? Well, from September 15th to the end of December. Let's just do a half month, and we'll worry about that in a second. We'll just do all of October, November, December. So 3.5 months, basically. So there's a few ways we can do this. We can do it in months, or we can do it in days. So here's how we're going to do it. I'll go ahead and do it in days, all right? That'll be easier for us. So let's figure this out. 3.5 months. On average, how many days really is that? Well, 3 months is usually 90 days, right? And half a month is 15 days. So let's do that. So 90 plus 15. 105 days. 105 days have passed. But total, right, is a year's worth, which is 12 months. We'll make it 360. So basically 105 days have passed over 360. So how we're going to do this, first we need to know what we're going to debit. When you're recording a debit to rent, we always debit what they call rent expense. Rent expense shows that you're using up rent, right? Rent is being used up. And how much is that for? We're going to do equals this amount, what we got it for, and we're going to multiply it times 105 divided by 360 for the amount of time that's passed. And there you go. 15,983. So we're just figuring out the portion of the rent that we've used up this year. So since we had prepaid rent, we prepaid that account. It's prepaid rent's going to go down for what we used up. So we're going to credit here prepaid rent because it's basically going down. Equals this number. Okay. Lastly, at the end of the year, supplies balance is now $1,200. Let me move this back, sorry. Supplies balance is now $1,200. So that means that we've used up a portion of those supplies. How much did we use up? Well, if you remember, we got it for $2,200. And we used up, it's now only $1,200. So what did we use up? The difference, and I'll show you. First, we debit what we used it, right? So we call it supplies expense, using up those supplies, equals 2,200 minus 1,200. That's how much we used up, which is 1,000. We're going to credit what account's going down? Well, supplies. We used up supplies, and that account is going down. 1,000. And I'll do equals so you know how to do it in Excel, that number. So next, we'll get into the adjusted trial balance. Ooh, that was a doozy. That's a lot of work. I'm just going to go ahead and create this quick video just so you can just like chill out for a second, take a little break. All right, that was a lot of stuff. Now, let's go ahead and jump back in to the adjusted trial balance and we'll finish up. Okay, so now let's go into the adjusted trial balance, the last leg of the race here. So we're just going to basically move the numbers down from our original trial balance and add in any numbers that we need to go ahead and update based on our transactions, our journal entries here. So first off, supplies. I don't see supplies, and that's the first one we had up here. So what we're going to do is we're just going to go ahead and copy these numbers down, and I'm going to update as we go. So moving down here, there we are. And let's go ahead and move this out of the way, and then right there. Okay. All right. So here we're going to look at cash. So what happened with our cash? Let's just go through that first before we do supplies. So first I see that we basically paid cash out for $2,200. So we need to reduce cash here by $2,200. So what we're going to do is I'm just going to mark down all the different credits to cash here, because it's going to be a few different things to cash. The next thing is 500 was a credit there. And then let's see what else. Okay, I see issued stock, and that's going to be a debit, and I'll just put that right here for 16,000. Okay, we paid for building 45,200, and then right here we paid for rent. So also, what was that, 54,800. Then we paid for off our accounts payable of 32,400. We got cash of 28,750. 28750. Then that looks like it's it. So here's how it's going to work. We're going to do this. We're going to do equals 24,000, what we started with. Let's just go ahead and add in 16,000 and add in 28,750. Then we're going to subtract. So subtract this number here, subtract this number here, 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 and then here. It says a negative number. So that's not realistic. Usually cash is never negative. So in this example, I'm going to make a quick adjustment just to make sure it's not. Let's just say that we got, we went ahead and we made a, let's see. Let's just say that someone invested in our company, right? And they gave us cash for that investment. Let's just say we sold more stock, okay? And we'll make it super simple here. Let's just say we sold stock for 100,000. So we're going to add in 100,000 here to make cash balance. And that 100,000 will just go directly to our common stock, okay? We're just going to make that quick adjustment just to make sure cash is not negative. All right, so next we look at inventory here. If we see, I always see inventory going down. That's it, just one thing. So 240, that's it. So let's go ahead and make that adjustment. We're just going to do equals 12,000 minus 240. There we go. Accounts receivable. So accounts receivable, I actually don't see anything with it, so we're going to ignore it for now. Prepaid rent, we did get prepaid rent here. We got it for 54,800. So let's go ahead and do equals plus this number there minus, there's one more thing, this number. We reduced it because we used up some of that rent. And there we go. That's our new prepaid rent, 42,217. Now equipment, I don't see anything for equipment here. Nope, nothing. Land, remember we did sell it, so it is removed from the books. So this turns into a big fat 0. Remember that right there. Accumulated depreciation, well, that does increase by 894. So we're just going to do equals 22,000 plus 894. There we go. Accounts payable. Well, we did pay off accounts payable here, 32,400 of it. So we're going to do equals and then minus 32,400. Additional paid in capital. Well, we did have that up here for 12,800. So we do equals plus, so equals plus 12,800. There we go. Now retained earnings, that's a tricky one. So retained earnings just keeps track of all your revenues and your expenses. So we're going to add to that. Let's not forget the ones that we haven't done yet. So let's go through here. We didn't do supplies, so we'll add that in here. I'll put that right here. So supplies, and let's go ahead and make sure we get the balance right. If you remember, we used up 1,000 of it. So at the very end of the year, it was at 1,200. Let's see what else we didn't have. Sales revenue, cost of goods sold. I'll show you where we put that in a sec. Building, we didn't add in building, so add in a building here. Building equals that number. All right. Building prepaid rent, we have that. Accounts payable, we have that down there. Accumulated depreciation, prepaid rent, we did that. Okay, great. I think that's everything. One more thing. We need to increase our common stock by 100,000. Remember, because I made that last entry there. Let's make sure I got that. Equals. There we go. Okay. So there is a difference, as you can see down here, and I know exactly what that difference is. Let me show you. So what I'll show you here is basically we need to go ahead and add in our revenues and our expenses to retained earnings. So let's figure that out. I'll just do some quick math here. So revenue 500 and no more revenues, just that one 500. What expenses did we have? We had 240 in cost of goods sold. We had a loss here, which is important. We need to record that loss. And we had depreciation expense, rent expense, and supplies expense. So a few things here. So what we're going to do is this. We're going to do equals, and we'll just get our income basically. So we'll start with our revenue of 500 here. Then we're going to go ahead and subtract out this loss, subtract our depreciation expense, subtract our rent expense, and subtract our supplies expense. It's a negative number. So what we're going to do is we're going to add that to our retained earnings. So equals plus there we go. 15,903 is now our new retained earnings. It was reduced by a lot. So we're still off by a little bit here. Let's go ahead and investigate and see why. So we did our loss, we did our land that was gone, accounts payable, prepaid rent, cash went down. Common stock. I think that was one we missed there. So let's do that. Common stock plus common stock, 3,200, there. Still off by just a little. So this happens in accounting naturally. You're just going to have to make sure these balance at the very, very end. We're off by a little over $1,000. So let's see where that came from. Did I reduce my supplies? I did. Prepaid rent was reduced. Yep. Accumulated depreciation. Yep. Depreciation expense. Yep. Land, cash, accounts payable. So there's a lot of different stuff here. Building, we paid for that with cash. 12,800. Inventory went down. Cash. So what I'll do here is I'll go and do a little investigation. I'll come right back to the video and I'll show you what happened. Okay, I figured it out. So two things. One, with cash, we subtracted 500. We needed to add 500 because 500 is up here where we got this revenue. Right there. So I went ahead and added that back in there in this formula, added 500 from our revenue to our cash. Then lastly, there's this 240 difference that we have at the bottom. And I found out what that is. We forgot to put in cost of goods sold. Cost of goods sold is an expense. So I'm going to go ahead and add that and I'll show you. We're going to do minus our cost of goods sold. And there we go. It updated our retained earnings, which is where our income goes. 224,277 equals 224,277. So as you can see, things don't always go according to plan, even in this video, but I went back through and I investigated to see what happened. And now it balances at the end. And that is how you make journal entries in Excel. We went from a trial balance to recording journal entries, recording adjusted journal entries, and then finally recording our adjusted trial balance. And that is how you make journal entries in Excel. So once again, make sure you like and subscribe to this channel just so you can support me in making more accounting videos to help you learn accounting online the easy way. Now comment below and tell me, how do you make your journal entries? Do you do it in Google Sheets or do you do it in Microsoft Excel? Comment below and let me know. Once again, thanks for watching, and I'll see you in the next video.